Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Hello, this is Hall Martin with Investor Connect. Today we're here with Christian Kameir of Sustany Capital. Christian, thank you for joining us.
Thank you for having me, Martin.
Well, great. Can you tell us a little bit about your background? What were you doing before you got into early stage investing?
Well, early stage investing for me started kind of in the 80s with investing my time into computer programming. So I'm a technologist at heart. But then after doing an internship at Siemens Nixdorf in the 80s, decided that this was probably not the best investment of my time. And so decided to get a law degree instead. I actually never submitted my doctor thesis at the end of the day because I got too busy with startups. So I ended up doing some regulatory work for the German Federal Communications Commission right out of law school, and then became general counsel for what was then one of the first large internet service providers in Europe. And we were just very lucky to sell the company early 2000 for $250 million. Shortly before NASDAQ hit its all-time high. And so then that allowed me to leave Europe and move to Southern California in 2000 to become a full-time VC in the technology space. So I've been doing this for some time and started writing about specifically sustainable information distribution about a decade ago. And then when I came across blockchain as a potential vehicle to facilitate that in 2014 around the Ethereum white paper, spent all my time in blockchain and started operating token sales shortly after. And then at the beginning of the year, we formed Sustany Capital to grow our team here. So we now have a full-time team of 10, mostly data scientists and analysts, to just do full-time investment into the blockchain space.
Very good, very good. So we recently held a blockchain conference in our area, and one of the takeaways from that conference was everything that can be digitized on the blockchain will be digitized. What's your outlook on digitized assets, and where do you think that's going?
Yeah, so as a technology investor, we kind of take a very nuanced approach to that. What I mean by this is digitization is simply from a technology process, the converting of information into computer-readable formats, right? So having been in the space for 4 years now, we've seen thousands of white papers and kind of started to break this down a little more. So what blockchain introduced is really, in essence, 3 new asset classes. One is cryptocurrencies, one is crypto commodities, and then you got crypto collectibles. And within those categories, currencies are really only Bitcoin Cash, Dash, Monero, Zcash, and things like Bitcoin and Ether and EOS. They are closer related to commodities as far as they're being treated and traded right now. And then as a third class, the collectibles, and that's kind of the most interesting piece as of late. You've got your ERC 721 implementations, such as the typical examples here will be CryptoKitties, but there's other more interesting examples coming down the road. And so those are really the new asset classes that blockchain technologies created. So in essence, you got blockchain native things, such as Bitcoin, and you got digitally native things. There you can think of your videos, your video games, your music, etc. So they are already digitally native. And for the most part, good old fiat currencies are already digitally native as well. So from that perspective, if you look at this, they don't really need to be digitized in that sense, but they need to be made digital bearer instruments. And that's truly the technology that the blockchain created, because if you imagine your typical bearer instrument, so your physical implementation of a fiat currency, your coin, or your pieces of paper in forms of, let's say, the US dollar, you hand them over, and by the physical act of transferring them, you don't have it anymore, someone else has it, and that's all that there's needed. So blockchains facilitate this process for the digital world. But obviously, that only carries over so far. So you can do this for currencies and money, and to some degree, for something that's already digitized. But needless to say, you can't really digitize anything that has a physical manifestation that you want to use, right? Maybe a house or a vehicle. So from that perspective, if you start breaking this down, even things such as shares, you don't really tokenize them to this date because the protocols are not as sophisticated yet. What I mean by that, the first more sophisticated protocols that are not just quote unquote currencies, and I can explain this in more detail, facilitate things that are blockchain native and that I can transfer from me to you and I don't have it anymore. So I can send you a CryptoKitty right now, I don't have it anymore, you have it. But obviously that doesn't work for most physical manifestations. So in that regard, it's linguistically and technically incorrect to describe digitization of assets in this particular way, because really what you need to be looking for is the technology that makes the transfer of the titles, as in the example of a car, more conducive to a transfer, but obviously that does not actually digitize this particular asset. And so lastly, and then I'll stop talking because I can give a 2-hour lecture about this particular topic. There's a lot of talk about quote-unquote security tokens. A token in the context of the blockchain is a peer-to-peer exchange mechanism. So what blockchains allow you to do is they create value exchange protocols using a token as the peer-to-peer transfer mechanism. So what that means for more complex assets is as long as you don't have a complete protocol that tracks all the elements that you transfer on a mainnet, on a public blockchain, you will still need to have some quote-unquote platform, or I like to refer to it as an on-ramp, in order to make this possible. So in short, this talk around security tokens, it's technically and legally incorrect because you will still, for the time being, have to use some kind of mediator / platform / on-ramp that is tethered to that particular token, which is obviously problematic. So i.e., to make a very specific example, if you had, let's say, shares of your company and you wanted to sell these to someone, then in the US context, you would have to verify that the buyers fulfill certain criteria, and these criteria typically checked by a third party, and this implementation then tethered to some form of platform or provider. So there's a lot of providers that are trying to provide this service right now, but needless to say, at best case, they maintain some form of a side chain, worst case, it's just their database that they maintain these particular assets in. So at that point in time, I hope I made it clear, it's no longer a token. Right? It's just another database entry. So really, the first time you can talk about a security token will be after things like identity and the security token protocols are solved on mainnet on a public blockchain.
Well, to zero in on the digitized assets as an area of interest, you mentioned the CryptoKitties, and that's an interesting case where there's a technology that generates a technology-only type asset. There's no physical CryptoKitty. It's all on software. And so the idea is it's very easy to transfer that back and forth and have ownership through that means. What other software-only type assets do you think will be coming up more in the business case that would follow as a next logical stage after the CryptoKitties?
Any in-game item, obviously, and then what we're working on right now with a couple of different teams as well, we're tethering it to real-world assets more closely. So what I mean by that, in the beginning of next year, our team here will facilitate a couple of initial wine offerings, initial whiskey offerings, and initial tequila offerings. So the way this works is you're issuing a token, an NFT, so Ethereum blockchain will be a ERC 721. And for the time being, because of the limitations of that protocol, it will simply track ownership and then maybe a little more, so be able to use a block explorer and actually see a picture, so to speak, like you can see now from the CryptoKitty on the public blockchain. But for the most part, all the functions will still need to happen on the side chain. But it provides the first step into this ecosystem. So what I mean by that, then what you can do on the other end for the physical implementation. So most likely our offerings will then on the wine end include something like an NFC token. So you can read this particular wine bottle into your app and it will reference back a token that's actually recorded as an NFT on the blockchain. And so you can transfer the token, and with that token you can then claim ownership. And there's already institutions such as wine custodians who will then, based on that, provide you with the actual physical element. And so this makes for a really good example, I think, for other things to come, because you can see how this from there will then translate to something more complex, to where you have other integrations that will be able to reference this particular NFT, this particular blockchain entry back to, let's say, IoT, i.e., I have a warehouse that's always at a particular temperature, and this particular information is then stored also mutably on a blockchain that's being referenced back to this particular NFT to simply show this particular item has been stored appropriately for the duration of which it has been in custody of this particular provider. Does that make sense?
Yeah, so when you made a comment earlier about how physical assets are not fully supported by protocols today. You need ownership and titles to be transferred if the asset is transferred. What kind of protocol do you think is going to come up to provide that level of support? As we all know, blockchain is still in its early stage, infrastructure stage, and the protocols are being built out. And it seems like this is a good area of investigation for companies to look at. But what do you see out there doing that now?
Absolutely. So I'll spend an hour or two every day reading through these proposals. And Ethereum is most obvious about this. So you can just look up Ethereum EIP's improvement proposals, and you can see the discussions around some of those standards. So the two most obvious ones for the time being that are being discussed a lot around identity and the whole security token topic. And it seems pretty obvious that identity is something you need to solve first for a lot of different implementations, right? For rights to, let's call it healthcare records, as well as rights to being able to purchase certain goods and services, such as securities, for example. Because unless I store that information about this particular person on a public blockchain, you'll always have to go back to some form of party that would then ensure that this person meets the criteria to be able to access this product or service. So that, in essence, kind of defeats the purpose of having a public blockchain. So in short, I think for the most important implementations you'll see, those will probably not emerge in the developed nations, but the developing nations are closer to that. So what I expect to see within the next 12 months is something like an identity wallet, and they are mostly for countries that simply don't have good solutions for their population to verify identities. So it's like here, everybody obviously has a driver's license and so forth, but in other countries around the world, there's combined more than 1 billion people that simply don't have identity documents. So once you solve this on the blockchain, let's say you can provide a solution that's app-based for a very cheap Android phone, then you can see how the next easy step then from there is to attach a digital wallet, so what this person for the first time also then has access to financial products. So that's really what's most needed at this particular stage from a global perspective, other than what we perceive to be important in the developed nations. But just like you can look back in time and see how certain countries leapfrogged some of our legacy technologies, i.e. wired phones. There's people in sub-Saharan Africa, obviously, that never had a wired phone, but now have an Android and other smartphone. And so in that same vein, you probably heard this before, those particular people then also leapfrog our legacy banking system. Because at the end of the day, if you think about this, it's a little silly that we still have to use banking systems been around for decades and that have your money disappear for days on end, where 90% plus of money is really only existing in digital form at this point in time. And I can send you an email in seconds and don't pay for it. At the same time, I can send you, for the most part, money in split seconds, and oftentimes I'll pay for it, and or there's 5 banks involved that then have to store that information. So a billion people around the planet, and even a child born today will never experience that. There's a very high likelihood that a person born today will never have a bank account. They will start out with a digital identity and a digital wallet. So that's kind of a long-winded answer to describe what's needed most and where kind of the movement is coming from, rather than looking at it from a pure investment perspective, but what's actually needed and what this technology can provide.
So for your fund, what is your investment thesis for this sector? What are you looking for at this time, given the stage of blockchain development and the limitations of the protocols that are there right now?
Yeah, so for the most part, our investments have been in kind of, let's call them infrastructure projects. So early on, we supported Ethereum, we contributed to their ICO, but actually not in the expectation that we ever see a return on that, which, I mean, luckily we did, but then also we support all the other protocols in that sense. So right now we're closely focused on this whole NFT, non-fungible token topic. I think there's a lot of utility to be had. Specifically, we just created a partnership with a gaming SDK, so a software development kit provider, which integrates the existing software development tools for the gaming space with blockchain, so that you can create in-game items that you can then actually own for good, that you can store into your digital wallet and that can transfer it to you. And that's an enormously big market. That's almost $100 billion market a year of these in-game item sales. So it's bigger than movie and music combined at this point in time. And this particular technology will make it grow even more. If you look at games such as Fortnite, they had in-game sales in some months that exceeded $350 million. And if you saw the recent raise of Epic of $1.2 billion for Game Studio, you can see that they realize where the value lays there. But then from our perspective, what's interesting is, and what's developing the standard specifically, you can see the utility of particular protocols in games. So to make a more specific example, if you owned a CryptoKitty right now, all those functions like breeding and racing and whatnot, they all happen on sidechain, which is to say not on public net. And it's really something that's more a database than actual blockchain implementation as far as its actual utility. But as these functions prove useful and desirable to users on this particular sidechain, you can see how they move to the mainnet. So that's actually what happened specifically in the CryptoKitties case, where those things were developed before it was even part of mainnet, but because it provided so much utility, was then forked into the public blockchain. And by being able to have a test case like this in a virtual environment, you can easily but scalably then figure out what provides utility or perceived utility to users. So just yesterday, we had a meeting with someone who's been in the gaming space and designed these games for decades. And so we're talking about things like testing identity protocols in a game environment, because you can imagine if you can outfit your avatar in a certain fashion, you do the simple things, you pick your gender and your hair color and whatever have you, but you can see how all of these things can also obviously then from there transcend to the real world, where you would like to store all of that information about your own person in a manageable fashion on the blockchain. And there's a lot of confusion always about that particular topic on blockchain, because people think, oh, now it's public. No, it's not. It's stored securely and you have the private key to it, and you for the first time get control of this particular entry. That also has super immediate implications to every business on the planet right now. I'm sure you're aware of GDPR in Europe, of the General Data Protection Rights Act in Europe that kicked in May, and that has enormous fines attached to it for people that violate those rights. So it's the right of every European to manage their own identity in granular detail. So violating these particular rights can become super costly to any entity, doesn't matter if it's in Europe or here. And California is proposing almost a copy of this particular act, albeit implemented slightly different. But the only granular solution right now to that problem is really to remove all the data that you have for any clients out there, because you can't give them granular control unless those protocols exist. So there's an immediate need for a lot of companies out there for this particular solution that is not very obvious to anybody else at this point in time. So we'll focus narrowly on those. And then lastly, and then I'll stop talking again, because as you can tell, I can go down deep rabbit holes on these topics, as what we are looking for specifically is more large-scale applications for things such as point-of-sale systems, right, where you don't have to know as a consumer or as a merchant that it's actually deploying blockchain, but it's simply cutting out the legacy banking systems.
So if you look at non-fungible tokens, the examples we brought up, CryptoKitties and in-app assets inside gaming solutions are still software only. But when you start moving to physical assets, say a home or a car or what have you, it seems like you have to have the real estate industry, the mortgage industry, the financial industry working with you. So if you were transferring that asset from one to another, that title transfers with it. Do you think smart contracts will be able to do that by themselves, or do you think there's going to have to be a much more robust protocol or system around that to actually make that transfer work, given there's physical entities that are involved with these physical products? And just because I sell you my car, but the car is still in my possession, do you really have control of that car, even though you may have ownership? How does that part work out?
Honestly, it doesn't. It will take years, and it's not so much the technology that's the problem here. It's the incumbents that currently maintain those systems. And you got many, many data silos. And the one mistake that technologists often make in this space, including myself, is a lot of these data silos could be easily solved with technology, but there are incumbents that are holding on to those for a purpose, right? So think about your typical MLS system, etc. Of course, there are better solutions out there already, but there's just simply people that keep those data in particular silos for their own benefits, right? And then you have scores of government agencies that have data management systems that don't talk to each other. The last time I heard a number such as there were more ways of issuing birth certificates than there are states. There's like 150 different ways just to issue birth certificates. So that is something so fundamental and simple. If you think about something more complicated, like transferring the title to a car and the inspections involved of that and potentially lease connection, etc. So you got several layers of data holders that would have to agree on certain standards ahead of time. So it's not the technology that's holding us back. It's kind of the legacy systems almost. So that's why countries that don't have to fight those legacy systems are actually going to, again, leapfrog more developed nations in that regards, because if you don't start slate or you're taking a way more progressive approach such as Estonia does, then you'll just delay it from an incumbent's perspective. The technology is there today. I can write an identity protocol, no problem, right? You could do it. It's not hard. What's hard is getting consensus for everybody to then start deploying and using that. And that's going to take years. So that's a huge problem for the United States specifically. You see Wyoming, for example, and Delaware having more progressive ideas for the space, whereas New York, for example, is pushing back hard, and that's a result of just lobbying activity and has nothing to do with technology. Right?
So if we look at the technology challenges that people face in putting these together, it'll be years before we get to other aspects of it. But if we're just working with CryptoKitties or in-app game purchases alone, there are still challenges in building these systems. One of the things we saw early on is that many of these applications were written completely in blockchain. Everything was in blockchain. And of course, blockchain has a great benefit for using it, but it's also can be difficult to work with and can be expensive and can be very slow and has scalability challenges. And so we're starting to see some groups move away from pure blockchain systems to hybrid systems, non-blockchain as well as blockchain working together, applying blockchain to the piece that needs to be applied to it. But what are the other challenges you see people in implementing these blockchain systems in the digitized asset space?
It's mostly not understanding that the paradigm has shifted entirely. Half of the time, the proposals that we're getting include words such as platform. That's already kind of the wrong way of thinking. What I mean by that is what blockchains allow you to do is they allow you to create value transfer protocols, right? in a peer-to-peer fashion. So the understanding that people need to have to approach this space correctly is understand whatever technology you're building, whatever solution you're working on, long-term as an on-ramp. So try to put yourself into the shoes of someone who wants to do a peer-to-peer transaction at the end of the day, right? So yes, for the time being, there's a lot of things that simply cannot be had peer-to-peer because there are certain things that a third party might need to facilitate. But unless you're working towards removing yourself as this point of friction, you're working in the wrong direction. And half of the time, the proposals that we're getting for investment just put another rent-seeking entity into the mix that's seeking to replace the current rent-seeking entity. That's the wrong way of thinking about this particular space.
So as an investor, what risks are you trying to mitigate when you look at these deals? Is it technology risk? Is it team risk? Or is it market risk? Or, of course, it may be a little bit of all of it, but what keeps you up at night about these deals when you look at them that you think that's the key risk I have to fix?
Yeah, so investing is all about timing, right? You have heard this probably many times. You don't want to invest into the first social media network, you want to invest into the last one, right? And I've done many things in my past where it was just the wrong time. In 94, we tried to build a unified messaging system on the AOL backbone. What was ahead of in 94. Today is still ahead of its time, so we lost a lot of money. I tried to build Yelp before Yelp in 2004. It was ahead of its time because no one had smartphones and so forth. So what we're trying to understand closely, what is the right time to invest into right now? So we spend a lot of time paying close attention to the protocols. We have relationships with all the large VCs in this particular space, and we invest alongside with them. They send us deals, we send them deals. We stay in very close contact with the actual developers of that technology. We pay no attention to the noise. 99% of the information that's been disseminated about these topics are utterly misguided. I can show you any headlines from today that simply do not understand the basics of this particular space. People say stuff like they bought Ethereum. Obviously, you can't buy Ethereum, you can only buy Ether. So if you already don't get the language right to distinguish between what's an asset and what's the blockchain, what is the blockchain about, you should probably revisit fundamentals. So that's what we're looking for. And as far as de-risking it, so we're trying to educate and discern what teams understand it on principle, and then fast forward 3-5 years from now, where can this technology be? And we'll always chunk down our deal. So what that means is we'll do thorough market testing and have the teams that pitch us provide us with the actual client data. Is this actual scalable? Because as you pointed out, a lot of these things simply don't scale for very simple reasons. And I have heard hundreds of pitches in the last year. A team suggested to build something on the Ethereum blockchain. And as you probably already know, it takes time and it costs gas fees and whatnot. And what they simply described simply doesn't work. On the other side, there are already working blockchains out there that provide hundreds of thousands of transactions per second and are well suited to do the majority of things that you should already be doing, right? So for the most part, you should understand that ACH and legacy banking technologies don't have a future, that fiat currencies probably don't have a future in their current composition, right? And so in that regards, we chunk our risk down trying to understand what should we allocate to now and then validate this theory. So we're taking a very scientific approach to our investment thesis, because for the time being, we're just investing our own capital. We thought about raising a fund at the beginning of the year. We thought this topic is entirely overhyped. Everybody calls everything a cryptocurrency when there's really only a handful of cryptocurrencies in the space. And now everybody's obviously dealing with the fallout of that. So having said this, in the beginning of next year, we are raising a $100 million fund to then actually grow those smaller teams that we invested in that now actually provided the proof of concept, and where the end user will never have to deal with things like a runner, like a MetaMask or something else that's technologically cumbersome, like a dial-up system, but they will actually don't have to know that they're using blockchain. Well, what they will just experience as, hey, as a merchant, all of a sudden I don't have any credit card fees anymore. Oh, that scales very nicely. So this this time I can deploy $20 million and scale this particular network because it's a win-win-win scenario for the merchant, for their suppliers, and for the customer.
Well, great. Well, we appreciate you sharing your thoughts with us today. How best for listeners to get back in touch with you?
Pretty easy to find, regularly contributing to Forbes on a monthly basis. So if you just Google my last name, you'll probably find some of those articles. It's just Kameir. Pretty unique last name, and otherwise easily to find on LinkedIn. That's where I do most of my conversations these days.
Well, we'll put that in the show notes and look forward to having you back for a follow-up soon, as this industry is changing very fast and a lot of fascinating things are happening there with it. I want to thank you for your time today.
Yeah, thank you for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.